As you know, Bitcoin is very sensitive to market liquidity and also perceptions about risk appetite and risk premia. And, over the past couple of weeks, I think there have been headwinds building, right? From the government shutdown to a hawkish Fed cut that was done last month and uncertainty about December. And as you know, with the shutdown, Treasury liquidity, the Treasury general account's actually been building cash. So I think all of these created a cascade of problems that put pressure on crypto. But hopefully, as you know, headwinds become tailwinds when you can resolve these things.
Tom Lee opens by tackling the recent volatility in the crypto markets. While Bitcoin has shown signs of recovery, it recently fell below its 200-day moving average, a key level closely watched by traders and analysts. Lee explains that Bitcoin's price movement remains tightly linked to global liquidity, reflecting both the amount of money circulating and the market's broader appetite for risk. If you enjoy this kind of analysis, remember to like, subscribe, and turn on notifications for more insights on crypto and digital assets. Your support helps the channel grow. Thanks for watching, and enjoy the video.
So let's start right there, because we did have a bit of a bounce back here in Bitcoin and really across the crypto landscape today. But yesterday, as Katie Stockton over at Fairlead pointed out, Bitcoin broke below its 200-day moving average. I know she's watching some technicals there pretty closely. How about you?
Yeah, I think it makes sense to watch the technicals for Bitcoin. As you know, Bitcoin is very sensitive to market liquidity and also perceptions about risk appetite and risk premia. And, over the past couple of weeks, I think there have been headwinds building, right? From the government shutdown to a hawkish Fed cut that was done last month and uncertainty about December. And as you know, with the shutdown, Treasury liquidity, the Treasury general account's actually been building cash. So I think all of these created a cascade of problems that put pressure on crypto. But hopefully, as you know, headwinds become tailwinds when you can resolve these things.
Yeah, I want to hone in for a second, because I'm not sure we've been talking enough about it, but that funding stress we've seen in SOFR, I know there was data that was put out on Monday showing just a huge drop in that secured overnight financing rate on Halloween from the day before. Should we be paying closer attention to that and what that's meant in terms of the liquidity picture across asset classes?
Well, people definitely pay attention, Morgan, because one, as you know, that can often be an early sign of stress, but it also takes place when there's window dressing. So and banks are doing window dressing at the end of month. So I am kind of watching it, but I think those funding stresses have eased. And of course, it hasn't spilled over and reflected in what should be building stress in either credit markets or in bank equities. And so I would just say that it's an anomaly, and it may be due to the shutdown. But yeah, it's worth watching.
Okay. Just the fact that we have had this deleveraging event, if you will, in Bitcoin. What do you watch to know that that's washed out? And I guess perhaps just as importantly, has this been playing out the way it has previously in the market?
Yeah, in some ways. I think we have to go back to two different episodes. 2022 when FTX collapsed, and then in 2020 when we had the COVID shock. And in both cases, those were really widespread deleveraging events in crypto, because as you know, in crypto, there is typically a lot of leverage. The October 10th deleveraging was the biggest in history. And that means there are still ripple effects being felt even 2 weeks later. There has been a DeFi protocol streamer that actually reported a pretty sizable loss, and that created further ripple effects. And that's what happened yesterday, along with this thing called the balancer hack. So I'd say it's probably still a couple of more weeks. The good news is there aren't a lot of bodies floating to the surface, so it doesn't feel systematic, but it's going to take some time for confidence to come back. And I think that's why crypto took it so hard in the last couple of weeks.
Got it. So what's the read through to stocks, specifically the QQQ or the NASDAQ 100? We know there's always been this very strong, or in more recent years, a strong correlation between the two.
Yeah, and the linkages are growing because, as you know, like market makers actually trade both products. And I think in general, people get nervous because part of it is stocks have been up 6 months in a row. And we have to keep in mind that in October, we had the wobble in the first half before markets found their footing. I wouldn't be surprised if people are just pausing here and saying, look, we still have the shutdown. We've had 6 months in a row, stocks are up, markets are overbought, and they get a little nervous. But let's say that just means a wobble in the first half of November. Since 1928, okay, 100 years of data, when markets have been up 6 months in a row, 5 or 6 times you build on those gains with an average gain of 3%. And in 1936, the market was flat. I'm sorry, 1942. So in other words, you either have a flat November or actually strong. It's actually a good sign we've been up for 6 months in a row.
Okay. Given all the focus there's been on stretched valuations, particularly tied to the AI trade, do you anticipate here then into the final weeks of the year that we're going to actually start to see this broaden out a bit?
Yeah, it makes sense. I think, we are doing more Zooms with institutional investors where they're talking about not 2026. So they're trying to position. And I mean, part of me would say, I think the Mag 7 and the AI stocks are still reasonably valued because they're growing at more than double-digit growth rates. And even NVIDIA, the biggest name and most important stocks, only at 29 times forward earnings. So they're not demanding. But there are plenty of stocks that have underperformed for 3 years, where their underperformance is so severe, you haven't seen it in 50 years. And so I think there is going to be some folks looking to buy mean reverting ideas, but I'd still say I like the AI. I think there's a lot of visibility, and I think companies are starting to see payoffs, so it still makes sense to stick with it.
Why alt season never really happened. And some of you may be under the impression that it has, or you follow people that say it has. But the reality is, when you look at the altcoin market relative to Bitcoin, one of the things you'll notice is that altcoins have been bleeding to Bitcoin really since 2021, right? They've been bleeding to Bitcoin since 2021. In fact, only a few weeks ago, they put in a new low of 0.29. So you could argue that the reason is because they never went to the range lows, because at the end of the day, narratives follow price, not the other way around. And you will notice that no alt seasons really ever occurred until after alt Bitcoin pairs hit 0.25. And of course, that has not happened yet. Right now, they're at 0.36. You should also note that just because alt Bitcoin pairs do hit 0.25, let's say that analysis actually comes to fruition and it pans out, it still doesn't mean that alt season has to be the very next day. It doesn't mean you can't have a rally off those lows, but it doesn't mean that it's the very next day.
Turning back to crypto, Tom Lee builds on on-chain data and historical cycle patterns to explain why the long-awaited altcoin season still hasn't begun. Despite occasional bursts of excitement, altcoins have steadily lost ground to Bitcoin since 2021, recently dropping to a BTC pair ratio of 0.29. Historically, major altcoin rallies don't start until that ratio nears 0.25, a level not yet reached. Lee emphasizes a key insight: narratives follow price, not the other way around. Without signs of a clear bottom in these ratios, it's too early to expect a full-scale altcoin rebound. He also notes that social engagement in crypto across YouTube, Twitter, and Google searches remains near historic lows. Unlike in 2017 and 2021, when retail hype fueled explosive altcoin gains.
One of the interesting charts about this cycle is the social risk, right? So we're looking at essentially social interest in crypto measured via YouTube subscribers, YouTube views, people following various crypto analysts on Twitter and exchanges on Twitter and layer ones on Twitter, or X if you prefer. And when you combine all that, you get a chart that looks like this. And in 2017 and 2021, you'll see there was a lot of social interest in crypto. And it was one of the reasons why Bitcoin dominance was going down, right? In 2017, late 2017 and 2021, we obviously saw alt Bitcoin pairs getting really impressive rallies. And it's because retail was here, right? Like, people were actually interested in crypto and not just Bitcoin. But when you have periods of low social interest, like we had from, waning social interest from January 2018 until the end of 2019, that's when alt Bitcoin pairs go down. Because there's more and more altcoins. There's not really enough liquidity to make them all go up. So only a few go up. And so there has not been an alt season this cycle, right? It's pretty clear there has not been one. And again, you could argue that it's because all Bitcoin pairs never went to the range lows. You could argue that we're still in quantitative tightening, which the Fed did announce will be ending in December. And one of the things you should note is that last cycle, alt Bitcoin pairs bottomed when QT ended. But that was not the start of alt season, right? It was not. It just, they were around those levels for a while until retail interest came back. So I want you to look at a specific chart, because I've gotten a lot of flack over the last few years for comparing this cycle to the 2019 rally, especially when I just kind of repeat myself over and over and over again, because, you know, like in 2023, I talked about how this was very similar to the 2019 rally and how Bitcoin was going up and dominance was going with it, right? Dominance was not dropping and we were not getting alt season. And in 2024, I said the same thing, how it continued to mimic the 2019 rally. And then in 2025, I've said the same thing, right? So every step of the way, I've said, look, guys, focus on Bitcoin, because Bitcoin will lead the way. It's not the altcoin market. And this, the only reason I was able to make this comparison is because I lived through the 2019 bull market and I saw how Bitcoin went up a lot. And despite the fact that Bitcoin went up a lot, if you look at total 3 divided by Bitcoin, despite the fact that Bitcoin was skyrocketing in 2019, several 100% in a really short period of time, alts were dropping against Bitcoin, right? They dropped a lot over a relatively short period of time, even during that Bitcoin rally. So that's the reason why I was able to make this comparison, is because I lived through these market conditions before, right? I saw how in the prior cycle, at that stage, when quantitative tightening was going on and higher rates, I saw how Bitcoin went up and the altcoin market slowly went up, but it didn't really, there was not really a great justification for holding altcoins back then, because Bitcoin was outperforming basically everything else. Just like this entire cycle, we've seen that. Also, further evidence that this entire cycle is more representative of the 2019 move is that the entire 2019 rally for Bitcoin occurred during quantitative tightening. The entire rally that we've had for Bitcoin this entire cycle has also occurred during quantitative tightening. Now, of course, that's going to end in December, but it does go to show you how this cycle has been similar to the 2019 cycle. And I would say that because quantitative tightening is ending in December, there's a good chance that Bitcoin dominance could skyrocket between now and then it might end up forming a top that lasts as a top for a little while after we get to the December point where quantitative tightening actually ends.
Analysts, including Tom Lee, note a clear parallel between this cycle and 2019, when Bitcoin rallied sharply during quantitative tightening (QT). Despite shrinking liquidity, Bitcoin surged then, and it's showing the same resilience now. With the Fed expected to end QT by December, history points to another potential turning point. Bitcoin dominance may peak into year-end, before easing liquidity opens the door for an altcoin rebound. In short, the cycle may repeat: Bitcoin leads first, altcoins follow next.